Hello everyone and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, and this video we are getting started with a section C question. So this is the first case study from your FM pre-June 2025 mock exam. The name of the question is Star Company. So we always do when it comes to our section C questions, we always get started by having a look at what the requirements are, what does the question really want from us. So the first thing that we're going to do is have a quick look at the requirements. So the first requirement says we're supposed to calculate part A, the cost of equity of Star Company before the expansion to appraise the new business area project, and we also have to explain our method. This is a requirement that's worth 3 marks. Then the second requirement wants us to calculate the theoretical ex-right price, basically the TERP, of the equity share of Star Company, assuming that the option to issue rights is chosen, explaining the calculations. Then the third part is we are supposed to work out the weighted average cost of capital WACC of Star Company after expansion, assuming that the funds are raised by issuing the loan notes. So let's give the scenario also a read now that we have a brief idea as to what all we are supposed to work out as a part of our solution. So let's read the scenario. Star Company, a listed entity engaged in manufacturing and selling of home appliances. It distributes the appliances through its own retail showrooms established all over the country. The company is currently all equity financed. Now, this is something which is important. Why? Because it has asked us to calculate the cost of equity before the expansion to appraise the new business area. Now, whenever you venture out into a new business area, your business risk changes. As a result, the equity beta changes. So, the equity beta that we put in the CAPM formula needs to be worked out again. But since this company is all equity financed, the asset beta is going to be equal to equity beta. No re-gearing will have to be done here. Globe Company is engaged in a different business that Star Company is considering as a new project. Its current capital structure comprises of debt to equity of 50-50 and its geared beta is 0.85. The shares of Star Company are currently trading at $5 and there are 200 million shares outstanding. For the year ended 31st December 20x4, the earnings before interest and tax EBIT stood at $66 million. Its PE ratio is currently 20. The EBIT is estimated to grow by 20% due to the expansion into the new markets. For further expansion, Star Company is contemplating to invest $200 million. After some discussions in a board meeting, the following alternative sources of funding have been identified. Option 1 is you make a rights issue to raise $200 million by the issue of sufficient number of rights shares at a discount of 20% to the current price, or another option is issue of 6% loan notes at its nominal value of $100. Pre-tax cost of debt is estimated to be 6%. PE ratio will remain unaffected by the debt issue. Equity beta will come out to 0.579. The corporation tax rate is given to us as 25%. Risk-free rate is 4%. Market premium is 7.5%. So this is all that we are given with. Firstly, we are supposed to work out the cost of equity for Star Company, and the emphasis being over here that we're also supposed to explain our method. So when we get started with first part, we are going to first write about the method. How do we write about the method? We're going to say that whenever we are changing the business area, we will have to calculate a project specific cost of equity, wherein we find out the asset beta of the proxy company and then we re-gear it for the company. But now here, no re-gearing is going to be needed because it's an all equity financed company. So we will say that the project specific cost of equity will have to be worked out by ungearing the geared, or you can say the equity beta, the geared beta of this company known as Globe Company. This beta will give us the business risk in the new project. This will ideally, this is usually regeared, for our own company, but that step is not needed. That step is not needed since star company is all equity financed. So this is how we explain the method, and now we can go ahead with our workings. So we know that the geared beta is given to us, geared beta, equity beta 1, and the same thing. It's given to us as 0.85. How do we ungear it? We multiply this by the value of equity divided by value of equity plus value of debt into 1 minus t. So to make our life with brackets easier, we can calculate VE and VD 1 minus t separately. 50 times 1 minus the tax rate. The tax rate was given to us, I think, as 25%. Yes. So 1 minus 25%. This is what we take up for VD. And how do we calculate the asset beta now? Asset beta is going to be equal to the fraction of VE divided by VE plus VD into 1 minus t. So 50 plus 37.5. This is what the fraction is. This needs to be multiplied by our equity beta. So our asset beta comes out at 0.485. So if we try to convert it to two decimal places, it's going to look like 0.49. And here no regearing is needed because star company is all equity financed. So now I start off with calculating the cost of equity. So cost of equity we do using the CAPM formula. CAPM formula is going to look like this. We take in the risk-free rate, which is 4%, and then we add to it beta multiplied by the premium. So the premium is itself given. We do not have to subtract the risk-free from it. So this is what my cost of equity is going to look like. We can convert this to a percentage. 7.64 is what the cost is going to look like. So this is the solution of the first part for 3 marks. Let's now move to the second part where we have to calculate the TERP. Here also we have to explain our calculations. So second part, we will say that currently the share price of the company is given to us as $5. We will say part B, current share price is $5. Issue price is going to be at a 20% discount. So into 1 minus 20%, that will give us $4. Now, how many number of shares will we have to issue? We want to raise $2 million. So if I want to raise $200 million, I will have to issue how many number of shares? Number of shares will be the money that I need divided by the price of one share. So I need to issue 50 million more number of shares. So we will explain our calculation. Till here we will say that current share price is 5. Issue price is 20% less than current price. So then we show the working of our issue price, and then we will say that the rights issue price will be this much. Star company, you can say here, star company needs to raise $200 million. So we work out the number of shares to be issued. So the number of shares to be issued is going to be 200 divided by 4, which will give you 50 million. So that means if somebody already holds, what will be the ratio? 200, existing already are 200 million of shares, and you are issuing 50 more. So the ratio becomes 4:1. Any person who was holding 4 shares in your company will be given an offer to buy 1 more share. So you will say that the rights ratio has become 4:1. And then we will say the TERP working is going to look like this. It will be how many shares did you have to hold earlier? Numerator will be 4 multiplied by the earlier share price, which is 5, plus 1 share will be issued. So 1 share, and how much will it be issued for? For $4. So this is our numerator. This has to be divided by the total of earlier shares plus the new share. Earlier we had 4 shares, now we will have one more extra share. So this will be 5. So now your TERP is going to look like 4.8. So this was the working of our part B. Now we will head towards solving part C. Part C wants us to calculate the weighted average cost of capital, assuming that we go ahead with the issue of loan notes. So the part C, or you can say this is 3 I's, issue of 6% loan notes at the nominal value of $100. Pre-tax cost will be 6%. PE ratio will remain unaffected. Equity beta will become this much. So we need 4 ingredients roughly. We need the cost of debt. We need the cost of equity. We need the market value of equity, and we need the market value of debt. This is all that we need. Cost of debt, the pre-tax cost is given to us as 6%. So the post-tax is going to be 1 minus 25%, which will be converted to a percentage. It's going to give you 4.5% to be the cost of your debt. Then the next thing that we are going to do is for the calculation of KE. So for KE, it has given us already what our equity beta will become. You take in the risk-free rate plus your new equity beta, which is 0.579, multiplied by the market premium, which is 7.5%. So now your KE is going to look something like this, 8.34%. Now we are going to find out the market values. Market value of debt is very simple, 200 million worth of debt. It's going to be issued at its nominal value of 100. And then we are going to be having the equity. Equity also, it says that the PE ratio remains unchanged. So 200 million multiplied by 5, which is the current market price, which is going to be 1000. So now we have the value of equity, we have the value of debt. Now calculation of WACC is going to be a piece of cake. So your WACC can be calculated as, first of all, you find out the proportion. Proportion is, let's also work around the total. Total of market value is going to be 1000 plus 200, which will be 1200. So your WACC is going to be, this fraction is for debt. This will be multiplied with your cost of debt. This is the first part of our working. And then we are also supposed to take in the second part, add to it the finance cost which pertains to equity. So equity is this much upon this much. This is the fraction of equity. And then we have to multiply this by the cost of equity. Cost of equity is 8.34. So you hit enter. This is what your final answer is going to look like. Converted to a percentage, 7.70% is going to be your WACC over here. So this is part A, all answered completely. Now we will move ahead to the next requirement, wherein let's see what it is asking us. Evaluate the possible impact of each of the financing method used on the wealth of a shareholders and comment on the acceptability of each method. So how do we really find out the wealth of the shareholders is how much worth your share price is. So what we can do is we can work around the new profit after tax, we can work around the EPS, and we can see what is going to be the new share price. So let's have a look. The expected PBIT, let's consider both of the scenarios one by one. Let's first talk about the rights issue. So if we go ahead with the rights issue, the EBIT, earnings before interest and tax, we are seeing that it's going to grow by 20%. Currently, my earnings are 66. So 66 multiplied by 1.2. This is what my earnings are now going to look like. Let's calculate how much this will come out to. 66 multiplied by 1.2 gives me 79.2 equals 79.2. This is my EBIT. Now here I do not have any interest because I'm financing via rights issue. Presently also I'm all equity financed. So I only have to pay tax. Tax is going to be paid at 25%. So how much is going to be my PAT? Let's calculate. I want to take away 25% from this. So 1 minus 0.25. 1 minus 0.25, that's going to give me 59.4. 59.4, and this is going to be my PAT. Now I want to calculate my EPS. For EPS, I need to divide the profit with the number of shares. So how many are going to be my number of shares? 200 million I already had, plus 50 more I had issued. 200 divided by 4 gave me 50. So 250 million now becomes the number of shares. So if you divide this by 250, you get your EPS, which is going to be 0.2376. So your new EPS works around to 0.2376. Now, how much is your share price going to look like? Share price will be EPS times the PE ratio. PE ratio. So this is going to be 0.2376 multiplied by the PE ratio, which was given to us at 20. So your share price is going to look like 4.752. So earlier with the TERP, we had calculated that the share price was going to be 4.8. However, if we go ahead with this option, our actual share price is going to fall to 4.75. This might not be what shareholders like. They will see a decline in their wealth. Hence, this rights issue may not be acceptable to the shareholders. So we've calculated the impact and we have shown we have also commented on the acceptability. So because the share price is going down, that means wealth is declining of the shareholders. So this option may not be acceptable to our shareholders. Then we will evaluate the second option where we are going ahead with the loan notes. So when we are going ahead with the loan notes, our EBIT is going to remain the same, 79.2, like we had worked out earlier. So you copy paste this. Now here, because we have taken a loan, we have to pay interest on it. So we end up paying interest. First, interest is going to be 6% on the amount that you've taken, which is 200. So let's calculate how much interest is going to look like. 200 multiplied by 6%. That gives you $12 million, which will go away in interest. Then you also have to pay for taxes. Taxes will be levied at 25%. Now, the income that you started off with, 79.2, from this you first take away your interest. So this gives you your profit before tax, PBT. Now you charge 25% tax on this. So this is what you're going to be left with. Your PAT is going to look like 50.4. Now here you divide this by number of shares to find out your EPS. Number of shares, because all of extra money is coming in through loan notes. So number of shares remain the same, which is 200 million shares. So you divide this by 200 million and now your new EPS is going to look like this. New EPS is 0.252 and that means your share price is going to be 0.252 multiplied by the PE ratio of 20. So let's do that into 20. That gives us 5.04. So this is even higher than what we had calculated as the TERP. So this option, with this option, you can see the price is increasing even beyond our expectations. This will increase the wealth of our shareholders. Hence, this method is going to be acceptable to the shareholders. However, one flip side, which you people should also be considering, is that with taking additional loans, your gearing level is actually increasing, which might make the company more risky for the shareholders. However, if you calculate the gearing, it's going to be 200 divided by 1200. 200 divided by 1200. How much does that give you? That gives you 16.67%, or you can say roughly 17%. So this is a fairly decent amount. You do not need to worry about this much level of gearing. Similarly, if you try to have a look at your interest cover ratio, your interest expenses are 12 and you have an EBIT of 79.2. So 79.2 divided by 12, you have an interest coverage of 6.6 times, which is fairly manageable. It's really nice that this number is this much. So shareholders should not be having a problem with this. Hence, loan notes option can be taken up. Now let's move on to the last requirement which pertains to this question. Discuss the various assumptions related to the capital asset pricing model. This is a 4-marker requirement, so it will be good to write 4 different assumptions here. You people have learned that as a part of your theory in the syllabus. So, number one assumption is that investors are holding well diversified portfolios. So, this means that they only want to be compensated for bearing the systematic risk and not the unsystematic risk. So, they are going to themselves remove any unsystematic risk. Second assumption is that the markets are assumed to be perfect. There are no taxes, no transaction cost. All investors know everything and they all take rational decisions. Third assumption that we know with respect to CAPM is that your investors can actually borrow at the risk free rate without any limits, and this is the minimum level of returns which the investors expect. And the fourth assumption which you people can write is the single period investment horizon that the CAPM model assumes. The CAPM model assumes that every shareholder is going to sell off the shares after 1 year of their investment. This assumption is usually made so that you can compare the returns on both of on different securities, and this is going to help you to avoid a period mismatch whenever you try to compare your returns. So these are a few assumptions which the CAPM model holds. So this was the solution for your FM pre-June 2025 mock exam. This is Star Company. I hope that this has helped you people. If you have any queries, you can ask me in the chat box here. I will just wait for a minute or two to see if you have any queries and address them. If you do not have any queries, then this is where we are going to stop. All the very best. Perfect. Thank you, guys. All the very best for your exam.